St. Louis. Welcome once again to What Retirement Means to You with Jerry Means. He's the president and founder of the Means Financial Group. I'm Spike Spangle. Jerry, how you doing?
I'm doing all right, Spike. How are you today?
Well, I'm doing good, but what's on your mind? What do we need to cover this week?
Well, I thought maybe we could talk a little bit today about internet searches.
The internet searches on how to retire. Nothing's ever wrong that's printed out on the internet.
Well, my take on that is the great thing about Google is there's a lot of information out there. The bad thing about Google is there's a lot of information out there.
Exactly.
So how do you decipher all of what's true, what's not true? Is there a hidden agenda behind what you're reading? So it's a little tricky. I mean, people come into my office and they're like, well, I read this. And I'm like, well, where did you read that? Well, I Googled it. Well, it must be true then.
Yeah, or the water cooler advice, or, how are you investing, or when are you going to take Social Security? So we want to talk about some of these myths, misconceptions, and see if some of these truths are actually true, or do we need to actually dig down, find the facts, and find out what kind of plan is going to work for you. Can I share a story with you, though?
Yeah, let's listen.
So, we had the holiday season a couple of months ago, and my father said the same joke to me that he said every single year. He said, well, I'm not worried about that because you're going to take care of me when I get old in old age. I took care of you when you were a baby. You'll be able to be there for me. And I get that tension of, I know how expensive it is. My mom has longevity in her family as well. Is this still a comment for someone like me, what is being called the sandwich generation, that we should just let go by?
Yeah, I hear that a lot. And, it may be true. There are some adult children that take care of their parents and it works out okay. But even with the best intentions, though, it doesn't always work out that way. You have a spouse that may not be agreeable to that. Or the child that you think is going to take care of you, they may need help. If you live 30 years in retirement, by the time you need help with care, your son or daughter might need help with care. Mm-hmm. So it's really definitely not a foolproof plan.
Yeah.
So you should investigate other options out there.
Yeah. The fallacy of the plan that we're setting up is hoping or expecting our kids and our grown-up kids to be able to take care of us. A few different things to factor in. There's the time, the emotional distress, and it is a financial stress as well. The sandwich generation, which I've mentioned, I'm not a big fan of this cutesy phrase for it, but it's 50 or 60-year-olds who are still working in their career. They got family, spouse, they're taking care of themselves, trying to save for their own retirement. They maybe have adult kids who could be struggling or maybe need help with a down payment on the house. And then their aging parents who they're maybe trying to help with healthcare. They're sandwiched in between choosing, well, who do I love the most, or who should I take care of? When that financial question happens, what would you like to say to somebody who's in the midst of this sandwich generation?
Well, I think it's really important to have some type of outside plan or insurance plan to take care of that. It's ideal. If you can qualify for it and you can afford it, it's the way to go. Now, I'll tell you a story, since you told one, about when I started in the business. I started in the business 26 years ago, and I was introduced to this thing called long-term care insurance. And I thought, what a great idea. People are going to need it. And, you pay an insurance cost and then it's covered and you have daily benefits. And, it sounded really like something that people could use and would need. But what I was told by this company that, came to me and said, offer this to your clients, is that they had never raised their rates. In 30 years of being in business, never had a rate increase. So I went out, offered this to all of my clients. What do you think they did to me the next year? I had a huge year doing this for my clients.
Raise the rates.
30% rate increase. So if they were paying $1,000 a year, they were paying $1,300 a year, right? Now, today, that's a cheap plan.
Oh,
but
yeah.
back then, that was an expensive plan. Yeah, so I had three choices. I had to go back to the clients. I had three options, and I could say, listen, keep the insurance, pay the rate increase. It's true, they never raised rates in 30 years, but they did now because more people are needing the care and they see that they underpriced this. The second thing is we can reduce your coverage and you pay the same amount you were paying before, but you have less benefits. No one liked that option either. Mm-hmm. Or option number three, you can be upset, you can cancel the insurance, but all of the money that you paid into it is gone and you no longer have insurance and you still have the same problem. So none of those three things was I crazy about. But I did the right thing. I sat down with every client that I put in one of those plans and I helped them figure out what was the best path forward. But I swore off long-term care insurance, that I'm never going to be put in this position again. People still need it, but I wasn't going to be the one that had to explain that to them.
Right.
So I would refer that business out. And I can tell you, even to this day, people come in and they say, you know, my long-term care insurance that this advisor put me in has tripled in premium, and we just can't afford it anymore. And I'll have someone that's 80 years old tell me that, and I'm like, you got to pay it now. You know, now is when you might need it. But people ask me, what's the alternative? Well, today there's been a revolution in products. There's so many other things that you can do. You can buy a life insurance policy that is permanent insurance, so the premiums do not go up, but you have something called an accelerated death benefit. So if you have a $400,000 death benefit on this policy and you need long-term care or home health care, you can trigger that death benefit early as a living benefit and use that money to pay for health care. If you end up not using it, then you leave a nice tax-free death benefit, if it's properly structured, to your heirs. So you didn't waste your money. The other thing is something called asset-based long-term care, where you can put a single dump in or a 5-year or 10-year pay, where you just put the money in there all at once. They cannot raise your rates, and it'll give you 3 to 4 times the amount that you put in coverage. What I like about those plans is, again, they can't raise the rates, but also if you ever want to cash the plan out, you can get your money back. Some of them have a 2-year waiting period. You know, you have to be in at least 2 years, but you actually can get a cash value walk away if you ever decide you don't want the plan. So only 3 things can happen in that situation. You need the care, you'll be glad you had the insurance. You decide you don't want the insurance anymore and you get your cash value out, or you pass away and it also leaves a tax-free death benefit. So there are still solutions out there. And then the last thing is some of these annuities that we've discussed that have income riders, there's no health qualification for those. They basically ask, are you in a nursing home currently? You say no, you qualify. And if you're getting income off of the annuity and you can't do 2 of the 6 activities of daily living, like eating, bathing, transferring out of bed, they will double that income. So it's just like flipping a claim, flipping a switch, and you get twice the amount of income. Now, it might not cover a whole stay, but it definitely can help with handicapping the house, you know, putting up ramps and things like that, or helping a nurse come in twice a week to do some of those things. Even if your kids are helping you out, it's nice to have that other person to come in and do some of those things. So there are options, but people aren't aware of these tools. They just think long-term care insurance is one vehicle, and there's all these different options that are out there.
You've given me a little bit of relief from my family story. Quick question though, is this something that you think my generation of taking care of my parents should think of in being able to cover for them? Is this the conversation that I need to have with my folks and say, let's maybe start a time clock on one of these tools? Chicken or the egg? Should I be doing this, or should the parents who are going to be needing the care be looking at it?
Yeah, it never costs to have a conversation, right? I mean, we offer a no-cost obligation consultation where you can come in and you can bring your mom or dad in, or you can bring your son or daughter in and have that conversation with us. We can look and see what they qualify for and see what the best strategy out of the 3 would be, or the 3 or 4 strategies, which would be the best one for their situation. So yeah, absolutely, I think it's a conversation worth having versus just pushing it to the back burner and hoping for the best.
Folks, you can get your own on-track retirement review at no cost with Jerry Means right now. There are folks standing by this call center. Dial that phone number down on the bottom of the screen. They'll schedule an appointment with you. Every single week, we leave a couple of weeks of appointments available in the schedule. So call it as soon as you can, because those appointments fill up quickly. More of what retirement means to you and some of the fallacies of retirement planning. We'll give you the correct answers when we get back right after this.
We're a pretty small boutique firm. When you come into our office, it really does have a family feel to it. My wife works in the office. My son works in the office as well. We also have our dog Maui. He's kind of the mascot. When you do come in, you meet our receptionist, Jen, and we call her the Director of First Impressions because she's great with people. We have a small building that I own. It's very easy to pull up and see us and walk in and get greeted right away. Something that I hear from a lot of people is they just feel comfortable. They feel like they're sitting down and sitting with a friend already. We just sit down with them and educate them and tell them about our services and what we do and how we do it, and try to find out if we're a good fit. A lot of my staff is family. So it is a family business, you know, and most people that come in, that's the most important thing to them is their family. So it's good for them to see that in our environment.
Welcome back to What Retirement Means to You with Jerry Means. He's the president and founder of the Means Financial Group, and we want to get your retirement on track. We're going to give you tools and tell you exactly how you can do that in just a few moments. I'm Spike Spangle. We're trying to go through some of that, goofy internet retirement research, the water cooler advice. One of those pieces that I always hear is, I'm not worried about my taxes or how much I have in tax-deferred accounts because my tax rates are going to go down in retirement. I don't have an income anymore. True or false, Jerry?
Well, I believe it's going to be false. I mean, just looking at tax rates today, I mean, we all complain about taxes, but historically, we're in one of the lowest tax rate environments that we've ever seen. So almost anyone that I talk to is going to say in the future, tax rates are going to go up. So even if you have less income, the tax brackets themselves may go up. So that's one thing to consider. Also, we lose a lot of tax deductions, right? The house is paid for, you lose the mortgage interest. So things like that. The kids are grown. You don't get that deduction for the kids anymore. So, and if one spouse passes away, now you're a joint filer, not a single, you're a single filer, not a joint filer. So you're automatically thrown into a higher tax bracket. So I have found also in retirement, people still like to have a nice income, right? I mean, they don't drastically reduce their income. They want to stay somewhere where they're close to where they were at when they were working. So you throw in all of those other factors, and to me, I've just found that it's a myth. I still have people come in from this show, from live events, and that's their biggest concern is, I feel like I'm getting hammered in taxes. What can we do differently,
Well, and you've come up with a bit of an answer to what you can do differently. First of all, it's understanding how much you have in taxes in your tax-deferred accounts. And if we can explain this is incredible, a wonderful light bulb that you've explained to me. If you think out there about how much you have in your tax-deferred accounts, your 401ks, 403bs, 457s, am I leaving anything out?
No, you got it.
Yeah, the whole smorgasbord there. We've been taught as a country to save tax-deferred for about the last 4 decades, since about 1979, when they discovered the 401k loophole in the tax code. So there are millions of Americans with hundreds of thousands, if not millions of dollars in tax-deferred accounts. Eventually, they're going to have to pay those taxes.
Correct.
So you created a tool. Let's see if we can bring that up. We've got a tool for you. It's called meantaxes.com. Because taxes can feel mean, right? No, it's based on your last name. But a little bit about the tax tool. We're going to find out what exactly, how much we have in taxes in those tax-deferred accounts.
Yeah, we want to look at, again, just that qualified plan. And then we're going to look, okay, you're deferring this, and if it grows at a certain rate, and you make a withdrawal down the road, what is that taxes going to look like? What are your required minimum distributions going to look like?
Yeah. So when you go to meantaxes.com, very, very simple, free tool. You'll put in your name, your email address, and how much you think you have in your tax-deferred accounts. And then you can use a slider on there, and it's going to tell you exactly how much you're going to pay in taxes on those tax-deferred accounts. Why this is so important right now is, haven't you said we're in some of the lowest tax brackets in U.S. history right now?
Yeah, as much as we complain about it, we're actually in a lower tax rate environment if you go back and look historically. So, when you look at our national debt and where it's going, everyone knows, you can look at all the different government calculators online. Speaking of internet searches, Well,
that one's real.
Go to usdebttalk.org and you'll see what the national debt is and how fast it's going up. How are they going to pay for that? Somewhere down the road, they're going to raise taxes to help handle that deficit. And so is that going to be during your retirement? Is it going to be during your kids' retirement? But someone down the road is going to pay higher taxes. So if we know what the tax rates are now, we can manage that. So this tool is a great way to just kind of get a snapshot and start that conversation.
Right. Folks, interactive show, you can do it right now. You can type into a web browser or into your phone, meantaxes.com, or you can use this QR code. Open up your phone to the camera function and then point it at that QR code, click on it. It'll take you right over to there. I'm telling you, 3 or 4 inputs, free tool, you'll see. And sometimes it can turn your stomach. I mean, if you've got over $1 million in tax-deferred savings with a 22, 24, 32, 37% tax bracket, you're going to see how much you owe in taxes. Then it's, what do we do with it? What do we do with that information? Roth conversion, Roth 401k, stop contributing to those. What do we do when we find out these taxes?
Well, we're going to investigate all of those things, right? Maybe making withdrawals early. Maybe taking some money out if you're over age 59 and a half, and maybe just flat paying some of the taxes right now if you don't want to do the conversion. I mean, I had a client come in the other day, or a potential client, and they were fortunate. They had a $2 million IRA. They haven't needed any income off of the plan, but now they've reached that magic age of 73, and they have to take the required minimum distribution. Well, the distribution on that plan is about $80,000 that they have to take out in income. Well, when you add that to Social Security, their pension income, you know, it threw them into a much higher bracket, and the person sat there and said, I really don't want to make this withdrawal. And I'm like, well, that's the thing with the qualified plan is the IRS lets you grow this money compounded, tax deferred, but at some point they want to get some of those tax dollars. Well, if you're 60 or 70, right, or you know, early 70s right now, and you're looking down the road, maybe it makes sense to start taking some distributions now, so it's not such a big hit down the road, because it can cause alternative minimum tax. It can cause more tax premium or more premiums on your Social Security. There's a lot of negative factors. I mean, yes, you're fortunate that you've been able to save that kind of money, but you want to be a good student of your finances and make sure you're doing everything that you can do. And that's what we help people with our on-tax review, on-track retirement review, but also this tax calculator. We put that out there at no cost, so someone that can utilize that.
Information is powerful, but information with action is more powerful. You've got to do something with it. So we wanted to start the tool because rather than just going to your CPA in the first quarter of the year and saying, I want to pay as little in taxes as possible, you're trying to reframe a little bit how people think. And I got to tell you, sometimes it's difficult. People say, no, I want to save tax deferred. I don't want to pay a lot in taxes. But if you can pay the taxes now, what are the benefits of a Roth kind of account later down the road?
Well, when you put money into a Roth account, you're not getting any tax break today, but that makes sense because tax rates are really low, as we discussed. But that money grows tax deferred, but comes out tax free as long as you play by the rules. You know, you have to be over age 59 and a half, has to be at least 5 years in the plan. But if you pull that money out, let's say it's deferred for 15 years, 20 years. Think of all of that growth that you could have over that period, and now it's all tax-free income. So again, it's not one or the other. Maybe it's a blend of putting some into your pre-tax account and some into the Roth, and that's where we sit down and help people determine how much should go into each one.
Jerry, at no cost, you do the on-track retirement review. Will you tell the viewers out there how does the tax portion fit in? I know that you're not an estate planning attorney. I know that you're not necessarily a CPA, but you work with professionals and you tie this all together. You'll do this tax review for folks?
Yeah, we sit down and we want to look at that situation. Here's the thing. When you go in to see your tax preparer, that's what they are. They're a tax preparer. They're looking in the rearview mirror. They're taking everything that you've done over the last year, packaging it up for the IRS, filing a tax return, and that's what your taxes is, right? It's the rear view. We want to look through the windshield. We want to look ahead instead of looking at the rear view. There's a reason why the windshield is bigger than the rear view mirror, right? We want to look ahead, and we want to do some planning in advance, and most accountants don't do that. They're so busy, they're doing 300, 400, 500 tax returns during tax time. They don't have time to sit down and explain, well, maybe you should consider this. Plus, they want you to be happy with your tax return, right? So the more money you put into a deferred plan, the less you owe taxes this year. More likely you're going to come back next year and get your tax done by them again. I'm really sitting down and looking at it and saying, okay, but let's look 15 years down the road, 20 years down the road. Is it going to benefit you to maybe allocate to some of these other different buckets?
Right. If that makes sense to you, call the phone number right now. Get your own on-track retirement review. We'll do that tax review with you to help you see how you can get more efficient in retirement so you don't get taxed as much on your Social Security, so you aren't affected by IRMA, so you don't have to take out your RMDs. Taxes are how you really efficiently play the game in retirement. Call and get your own on-track retirement review right now. We'll be back with Jerry Means right after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to What Retirement Means to You with Jerry Means, president and founder of the Means Financial Group. I'm Spike Spangle. We're talking about some of that water cooler retirement advice. I've heard this phrase before. I don't need to have the same income as I made when I was in my working years. First of all, the family, the kids have moved out. Maybe we are done with the mortgage, but I'm not going to spend as much per month in retirement. Jerry, do you find that to be true?
I really don't. I found that people still are spending money in retirement. And listen, if your house is paid for, that's fantastic. But you're still going to have taxes. You still have an insurance. As we all know, that's going up every single year. I mean, I look at some of these insurance rates on a home, and it's ridiculous how much they cost. And then you have to keep in mind every day is a Saturday, right? What do we do when the weekend rolls around in our working years? We want to go out and do something, right? We want to go to the movies. We want to go golfing. We want to plan a vacation. We want to go to the lake. We want to put gas in the boat when we go to the lake, right? So just think of every day being a Saturday. You're going to want to fill that time with something. So unless you're volunteering every day, you're going to get bored and you're going to want to do stuff. So you're going to spend money. But there's all those other expenses that people forget about. You're still going to need car repairs. The animals still need to go to the vet. You're still buying things for the grandkids and helping the grandkids out. And maybe spending more time traveling to see those grandkids, right? So you have more travel expenses. So there's all these different things. So I've seen that people still need a pretty nice income in retirement.
Right. And then when you couple in inflation, just the natural increase of cost of goods and services, in a 10, 20, 30-year retirement, your costs are doubling every 10 or 12 or 15 years or so. So you've got to have something that's helping you fight those effects of inflation. I mean, on a Saturday, I think I spend $200-300 before 12 o'clock. I've got the honey-do list.
Yeah.
Go out to breakfast, got a couple of things you got to get fixed. You go into one of the hardware stores. I'm like, what happened? My wallet, I got a hole in the wallet. So then you're enjoying yourself as well. So you build in the income plan. So when people are trying to simplify it, because we all want one fast click for an answer, if we have enough saved, can I also go by that water cooler, the 4% rule? I'll just draw 4% for my retirement savings and it'll last me 30 years.
Yeah, here's the thing about the 4% rule. I feel like it's one of the biggest myths out there. Now, mathematically, if you look at the last 30, 40 years and you take an index like the S&P 500 and you look at what it's averaged and you do a withdrawal of 4%, it doesn't run out of money. And that's where that rule came from. There was actually a book written in 1994 that really introduced that rule that said, if I take 4% of my savings out and I have my money in the market, I won't outlive my money over a 30-year period. But here's the thing, that book was written when we were in a high interest rate environment, right? You could get 6, 7, 8% in fixed funds. The markets were booming. We were in the middle of the internet era. The internet was just coming of era. And we had all the dot-coms and 30% returns by just throwing a dart at the Wall Street Journal, because back then we didn't do it all on our phone. So that is an old, outdated rule in my opinion. And here's another thing. When you start doing that 4% withdrawal, negative markets really affect you. I've done charts for people to kind of show them this. If you invested in the Dow Jones Industrial Average in 1990, and you did the 4% rule, by the end of that decade, in 2000, you had more money than you started with. The rule worked. But if you did that same strategy, same index, from 2000 to 2010, you were broke.
Broke?
You were broke. The money's
Not even
gone.
just half?
The money's gone. Because think about it. 2000, we had the dot-com crash. 2001, there was kind of a hangover from that. 2002, it was the first time the market had dropped negative 3 years in a row. Then we had a rebound. Then we had the 2008 financial crisis, followed by some decent years, but they got hit in the beginning of the retirement. In 2000, 2001, 2002, you're pulling 4% out and you're getting hit by the markets at the same time. Just can't recover from it. So I always tell people, which decade are you going to get? Are you going to get the 1990 to 2000 or the 2000 to 2010? What's your first 10 years of retirement look like? Can the 4% rule work? Yes, until it doesn't. So we're not looking at the last 30, 40, 50 years of averages. We're looking at your retirement and what your withdrawal rate's going to be and what are the markets going to do over the next 10 years of your retirement.
Well, Jerry, makes me a little bit nervous. Are we trying to then time the retirement to kind of see what market are we going to go into, or are we slowing down the risk before we get to that retirement? Because I don't want to fall victim to that sequence of returns. If I start with 1 or 2 down years, you're not only taking those downs, but then you're also possibly paying taxes on the accounts that you're taking. You're doubling the losses.
Yeah. So I mean, I think today it comes down to segmenting your retirement into different buckets. You know, you want to have an emergency fund, right? So if, you know, a branch falls off your tree and smashes your car and you have a deductible, or, you know, it's not covered because it's an act of nature or something like that, you want to have that emergency bucket. You want to have an income strategy. You can use things like the annuities with the lifetime income. You know, you want to use something to guarantee your income that's not based off of the market going up and down. Once you've covered that emergency bucket and that income bucket, now you can take that money and you can put it in a bucket that can go up and down with the markets based off what your risk tolerance is. You know, so it's really just finding out what your comfort zone is on that bucket. But first, let's make sure that you have an income plan. And that third bucket, you can invest like you're 20, 30, or 40 because you've already covered the mortgage utility and groceries, the MUG, right? We use that acronym a lot. So I always tell people, hey, you're 70 years old. How would you like to invest like you're 30 and not have to worry about the markets? Who doesn't want to be 30 again? And they say, well, of course, we can do that in a bucket of your money, but let's go ahead and make sure that you've got that safety and that security of an emergency fund and an income bucket first. And then that's the overflow.
Jerry, for those who are maybe taking their financial retirement advice from the person, the guy or the gal in the office next to them, or their brother and sister-in-law at one of those holiday events, would you please tell them what the On Track Retirement Review is really about?
Yeah, so come in and get a second opinion. You're going to sit down with a licensed fiduciary advisor. We're going to go through, we're going to look at what is the taxes in your plan? What is your written income plan? And if you don't have one, we're going to provide one for you. We want to look at your healthcare situation. And basically, if you sit down, it's no cost, no consultation. Come in, have a visit with us. We'd be glad to help.
Thank you so much for watching What Retirement Means to You. Call that phone number, use the QR code with your phone, schedule your appointment. Thank you so much for watching. We'll be back with Jerry Means next week.